Hello, I'm Bernard Hickey from interest.co.nz and welcome to today's investing report. Today we're going to look at the issuance of Uridashi bonds. Now you may not have heard of these, but they're very important for our currency and for our interest rates overall. Over the last 4 or 5 years, people like the World Bank have issued these New Zealand dollar bonds to retail investors, to people we like to call Belgian dentists and Japanese housewives. Essentially, they're lending to us money that we don't earn for ourselves. Now, over the last 4 or 5 years, we've borrowed about $50 to $60 billion from these Belgian dentists and Japanese housewives. So we have to watch very closely the numbers that come through every month on how many of these Uridashi are issued. And in March, the news wasn't good. It was the lowest issuance in nearly 4 years. We issued just $313 million worth of Uridashis. Now that compares with $1.7 billion worth of Uridashis that were maturing. Remember, we've been issuing these things for several years, and every couple of years we have to pay them back, or that they're rolled over. And we have to hope that the Belgian dentists and Japanese housewives keep rolling that over, because if they don't, we'll have to pay the money back. That will drive our currency down and our interest rates up, and we won't be able to keep spending more than we earn. So we watch these numbers very closely. Now, is this the end of the so-called Uridashi flow, and are we about to see the Uridashi Tsunami crashing down on us? This is where more than $50 billion worth of funds is pulled out of New Zealand in a very short space of time. It's probably a bit early to say that yet. There have been ups and downs before, and certainly with New Zealand interest rates at almost 8% more than they are in Japan, it's still fairly attractive for many retail investors to stay here. But it's worth watching, particularly when you look at our currency. The New Zealand dollar has actually fallen very sharply against the yen in the last 6 weeks. We tend to watch what's happening to the US dollar, and that's been up around about 80 cents for quite some time. But when you look at the yen, it's fallen quite sharply. And this is a real risk, particularly for those retail investors, because the bonds are in New Zealand dollars. And if the New Zealand dollar falls, then they take a loss. And remember, they started investing in these Uridashis back in 2001 and 2002, when the New Zealand dollar to yen cross rate, which you can see here in the long-term chart, was actually down around 45, 50 yen. It's now up around about 79, but it's actually down from a high of about 86 just a few weeks ago. So if these Japanese investors decide that the currency is falling sharply, they may all head for the exits at the same time, and that would trigger a Uridashi tsunami. Too early to say we're there yet, but certainly one to watch, because if it does happen, we will see interest rates in New Zealand rise, and we'll also see our currency fall, which is just not good news for inflation, and will make the Reserve Bank's job that much harder. I'm Bernard Hickey for interest.co.nz. That was the investing report.